Thanks so much for tuning into this earnings conversation with Pidilite. Don't look at the stock price performance as a validity of what the business has done, simply because by virtue of the crude price falling over the last few days, the stock had anyways gained and preempted what has turned out to be quite a fantastic quarter one, especially in the volume growth number, which is head and shoulders above almost any company of that pedigree in that business segment. Mr. Bharat Puri Johnson to talk about that and more. Mr. Puri, great having you. Thanks for joining in. I hope all is well.
Great to see you, Dheeraj. Yes, all is well.
Okay, so talk to us. I want to start off with the volume growth straight off the bat and then move on to the other pieces. This is quite a large number, even if we consider the base that a fact that the base quarter was a COVID impacted quarter. What's clicked for you this time?
See, we've been maintaining for a long period of time that we have been investing for the future, that when growth comes back, we will be well positioned for the growth. So whether it obviously be our investments in supply chain, I mean, just to put it in perspective, we've completed 6 brownfield, 3 greenfield, and I have another 6 greenfield projects. By March next year, we will pretty much be ready for the next 3 to 5 years of growth. That's obviously given us a supply chain which has tremendous reach and flexibility. If you look at the whole digital piece and the way we've equipped ourselves, equipped our sales forces, I'll give you a simple example, e-commerce. When COVID happened, what we were selling in a year is now what we sell every month. 4 of my products are top sellers on Amazon. Now you would think in a categories like that, Pidilite are you going to have the largest sellers? Well, the largest selling rust remover is WD-40. The largest selling acrylic paint is Fevicryl. The largest selling drain declogger is Declog. So it's a lot of work that has gone on behind on the whole digital piece. Of course, a lot of it is internal. Innovation, as we said, when COVID finishes and markets return to normalcy, innovation will start kicking in. We will pretty much all across my divisions, we will have a new product launch pretty much every 3 to 6 months, and those are just beginning to happen. And of course, in all of this, in the end, it's the culture and the team that matters. And, when you've got a team that is raring to go, I think all of that combines together. I would still put a note of caution. It is on, while yes, the CAGRs are very healthy, I would say the next 6 months when inflation has fully kicked in and, the consumer has realized the impact of the raised prices, we do expect some moderation in demand. I think our focus has to be profitable volume growth. That's what we will focus on. And on the raw material and input material, we've been having a perfect storm. In fact, quarter 2, which is the quarter that we are currently in, will actually be the highest raw material cost that we've ever recorded. So therefore, when you see our performance in quarter 2, margins will still be under strain. The good news, however, is we are beginning to see light at the end of the tunnel. Raw material prices are beginning to ease. And, again, these days, it's not a good idea ever to predict the future, given all the uncertainty around geopolitics. But it does appear that in the second half of the year, margins will come back to a much more normal range. Our principal raw material, VAM, vinyl acetate monomer, was $2,600 a ton in the second quarter. It has moderated to $2,000 a ton. And hopefully, as we go forward, it will come back to more reasonable levels. And if that does happen, that obviously gives us further fuel to invest back into growth, because we do feel that in the second half, the focus has to be on profitable volume growth because inflation has been substantial. And you can see some impact of that already in the rural and small town markets. Over time, we do believe that it will impact all consumers.
Okay, I'll just take one quick question on the margins because you've already told us everything that probably needs to be known. But just one question. Starting COVID, all our enterprises tightened the belts quite significantly. A lot of that action would have been behind. Should crude not cool off? Should some of the other commodities, VAM or otherwise, not cool off substantially from the current levels? If that were to happen, is there room to really tighten more, or then you would say that, hang on, let me not disturb what the organization is going through. We'll take 2-3 quarters of pain.
See, we've actually, if you notice the last 4 quarters, we have taken the pain. We have moderated our margins. We believe that this is not a permanent phenomena, and it is not fair to load the consumer with all of the price impact of the input costs. we've consistently maintained that we will be very conservative on pricing. Our traditional margin, which used to be between 20 to 24%, we've now actually moderated it to 17.5, 18.5. Because we believe that, listen, in the next 2 quarters, moderation will happen. This is not because of demand issues, but because of supply constraints. And therefore, as an emerging markets producer where volume growth to our minds has to be paramount, we would rather take 2 quarters of lesser margin, but not let the momentum on volumes go up, because frankly, margins will come back when they will come back on the larger volumes.
In fact, I was about to ask you that on larger volumes, on much higher number of product range that you have, if margins do come back, then that could actually be a big kicker. Surely you're not suggesting that margins will go back to erstwhile levels, right? When you say come back to normalcy of 18, 18.5 or thereabouts.
It's impossible to predict right now, Neeraj. I made this prediction in Jan where we said, and then Russia-Ukraine happened. I would just say that, listen, we will manage this quarter by quarter. But the way it is looking and the spot prices that are now coming in for our major raw materials, it does appear that the second half of the year, we will see pain in this quarter. And then in second half year onwards, margins will start inching back upwards.
Got it. A word on what I made out of your first answer. It almost now seems to be that while the elephant, and the pun is intended out here, continues to march, you are building category leaders, which they are category leaders, but you're building them up to actually scale up quite meaningfully over the course of the next 8 to 12 odd quarters. Would that be a fair assessment?
Absolutely, yes. We've consistently maintained that we have 3 kinds of categories, 4 categories where we grow the categories, products like Fevicol, Fevikwik, M-Seal, where we continue to grow the categories. We have growth categories like waterproofing, like floor coatings, etc., where we have to create the category. And then we have pioneer categories like things like tile adhesives, etc., where we have to pretty much create the category until it becomes a growth category. And we have actions across all 3. The good thing is, if you look at our growths, and frankly, not just over the last 3 months, but over the last 15 months, we've consistently broad-based our growth. It is across categories, it is across geographies, and therefore it is, the whole army marching forward rather than just 1 or 2 stars.
Yeah, fair call. Mr. Puri, just one final question, really, because it's a busy morning for you, I understand. Just trying to understand, as a percentage of the overall costs in a project, right? All things put together, it will not be a substantial one, right? The products that you are selling. So therefore, my question is, if indeed the construction cycle, which, say, for example, Havells or somebody else were saying that developers were trying to push back a little bit to the next quarter because of increasing input costs. But my question is, if indeed that reverses and the construction cycle does pick up, the developer cycle does pick up quarter on quarter, does that add a zing further to the already splendid volume growth numbers that you put out?
See, to my mind, the volume growth numbers again have to be seen in the context of the
forget the percentages, sir. Yeah. Forget the percentages.
But very simply, if construction activity keeps stepping up and new construction, which is organized real estate, comes back to the party, it's always a benefit for us, because pretty much 1/3 of demand comes out of new construction, and if that steps up, it obviously gives us a kicker. And what we are finding from a tailwind point of view, Neeraj, is actually that consumers have, in a sense, re-examined their relationship with their homes post-COVID. And there is a surge in home renovation, home upgradation, which we are seeing the benefits of. We're also seeing, and you're now seeing this with all of the hospitality companies, etc., all of which was closed. If you have to reopen and, if you keep something closed for 2 years or near closed, then you have to renovate again, we benefit. So the overall tailwinds in housing, real estate, commercial real estate are really a kicker. The good monsoon is a kicker. The headwind is clearly consumer inflation. The consumer, she's paying a lot more this year for virtually everything than she was paying last year. And that therefore moderates demand.
Yeah, and you've given us twice enough indication about watching out for that. What does she do in the next couple of quarters when she's burdened with this consumer inflation? So fair point. Would be lovely to understand from you at the end of quarter 2 as to how did it shape up and then what the rest of the year looks like. But thank you so much, and congrats once again on a fantastic set of numbers.
Thank you, Neeraj. The congratulations is really to the team. Thank you so much.
Indeed. And viewers, thanks for tuning in.